Hello, welcome to Capital Sensei. Today we're diving headfirst into a book with a pretty bold title, You Can Be a Stock Market Genius by Joel Greenblatt. We'll unpack his core strategy, which isn't about picking the next big tech stock, but about finding gold in places most investors completely ignore. We're talking about spin-offs, mergers, bankruptcies, and other special situations where Wall Street's structure creates incredible bargains for those who know where to look. Whenever we can, we try to answer questions left in the comments. Learning about this stuff is a journey, and hearing from others on the same path is incredibly valuable. So please, feel free to comment with your own questions, your own stories, or any insights you have. It helps all of us build a smarter community of investors. All right, let's get into it. The title, You Can Be a Stock Market Genius, sounds like pure hype, right? But Joel Greenblatt isn't some fly-by-night guru. He's a legendary hedge fund manager who for a decade generated annualized returns of over 50%. Yes, you heard that right, 50% year after year. And the funny thing is, his secret wasn't some complex algorithm or inside information. His whole philosophy is surprisingly simple. Go to the places where nobody else is looking. Most investors, both professional and amateur, spend their time analyzing the same 500 or 1,000 big, well-known companies. It's like a crowd of fishermen all casting their lines into the same small, overfished pond. Sure, someone might catch a fish, but the competition is fierce. Greenblatt's advice is to find your own private, well-stocked pond. And these ponds are what he calls special situations. These are messy, complicated corporate events that cause big, institutional investors to sell shares for reasons that have absolutely nothing to do with the underlying quality of the business. Let's start with the big one, the cornerstone of his strategy, spin-offs. A spin-off is when a large company decides to take one of its divisions or subsidiaries and turn it into a brand new, separate, publicly traded company. The parent company then gives the shares of this new company, the spin-off, to its own existing shareholders. Think of it like this. Imagine a huge conglomerate that owns a successful pizza chain, but also a small but profitable bicycle factory. The market values the conglomerate based on the pizza chain, and the bicycle factory is just a forgotten footnote. So the company decides to spin off the bicycle factory. Now it's its own independent company with its own stock. Here's where the magic happens. First, the big parent company, the pizza chain, tells its story to Wall Street every day. Analysts know it inside and out. But this little bicycle factory? Nobody knows anything about it. There's no analyst coverage, no fancy reports. It's an information vacuum. This lack of information is the first ingredient for a mispricing. Second, and this is the crucial part, think about who gets the shares of this new bicycle company. It's the shareholders of the giant pizza conglomerate. Many of these are huge institutions, like mutual funds or pension funds that have rules. Some are only allowed to own stocks in the S&P 500 index. This little bicycle company is way too small to be in that index. So what do the moment those new shares land in their account? They sell. They don't even look at it. It's an automatic, forced sale. Others might just see it as a tiny, insignificant position in their portfolio. If you have $100,000 in the pizza company, you might get $500 worth of bicycle company stock. Most people just sell it to clean up their portfolio. So you have this wave of indiscriminate selling from people who are not selling because they think the bicycle business is bad. They're selling for purely technical, institutional reasons. And what happens when there's a flood of sellers and very few buyers? The price goes down, often way below what the business is actually worth. This creates the perfect hunting ground for an individual investor. You, unlike the giant fund, can take the time to look at this little bicycle company. You can read its filings, understand its business, and see if it's a gem that's been tossed in the bargain bin. Greenblatt found that on average, these stocks tend to significantly outperform the market in the first few years after the spin-off. You're buying a potentially good business at a price that has been artificially depressed by factors that have nothing to do with its future prospects. So, what should you look for in a good spin-off candidate? First, look for spin-offs that the big institutions are likely to dump. The smaller and more obscure, the better. Second, check to see if the insiders of the new company, the management team, are buying shares. If the CEO and CFO of the new bicycle company are using their own money to buy up stock right after it's spun off, that's a massive vote of confidence. They know the business better than anyone. Third, look for a profitable business with a clean balance sheet. You want a company that is already making money and isn't loaded down with debt. The parent company sometimes loads up the spin-off with a lot of its own debt before sending it out the door. So, you have to be careful. You're looking for a healthy business that was simply hidden inside a larger corporation. It's like finding a future superstar who is playing backup for a famous band and is now finally going solo. You get in on their first album, right before they hit the big time. Now, let's move on to another one of Greenblatt's favorite fishing ponds, risk arbitrage, or as it's sometimes called, merger arbitrage. This sounds complicated, but the concept is actually pretty straightforward. It all centers around announced takeovers. Let's say Company A announces it's going to buy Company B for $10 per share. The moment the deal is announced, the stock price of Company B will jump up, but it usually won't go all the way to $10. It might go to, say, $9.50. Why the gap? Because there's always a small chance the deal won't go through. Maybe regulators will block it, or maybe Company A's shareholders will vote it down. That 50-cent gap between the market price and the deal price is your potential profit. A risk arbitrageur buys the shares of Company B at $9.50, and if the deal closes as planned, they get $10 per share, making a 50-cent profit. It doesn't sound like much, but let's look at the numbers. That's a profit of about 5.26%. If the deal is expected to close in, say, 3 months, you can annualize that return. Making over 5% in 3 months is an annualized return of more than 20%. And here's the beautiful part. That return has almost nothing to do with what the overall stock market is doing. If the market crashes tomorrow, as long as the deal still closes, you make your money. It's a strategy that is largely uncorrelated with the market's ups and downs. Of course, the name risk arbitrage has the word risk in it for a reason. The risk is that the deal falls apart. If that happens, the stock of Company B will likely plummet back to where it was before the deal was announced, and you could lose a significant amount of money. So, the game is to figure out the probability of the deal actually happening. You need to become a bit of a detective. Greenblatt gives you a checklist. First, read the press release and the merger agreement. Are there any weird conditions? Is the financing for the deal already secured? A deal that is all cash is generally safer than one that relies on the buyer's stock. Second, are there any obvious antitrust or regulatory hurdles? A merger between two giant competitors is much more likely to be blocked than a merger between two smaller players in different industries. Third, what's the motivation? Is it a friendly deal where both sides are happy, or a hostile takeover where the target company is fighting back? Friendly deals are much more likely to close. You're essentially weighing the potential upside against the potential downside. If you stand to make 5% if the deal closes, but you could lose 30% if it fails, you need to be very, very confident it will close. Greenblatt suggests only participating in deals where the odds are overwhelmingly in your favor. You want to bet on sure things, or as close to a sure thing as you can get. It's not about hitting home runs, it's about consistently hitting singles and doubles with a very high batting average. Another fascinating area Greenblatt explores is bankruptcy. Now, I know what you're thinking. Bankruptcy? That sounds like the investing equivalent of dumpster diving. And you're not wrong, it can be incredibly risky. But it's also where some of the most spectacular fortunes can be made. Precisely because most people are too scared to even look. When a company files for bankruptcy, its stock is usually wiped out and it becomes a pariah. But the story doesn't always end there. There are different layers to a company's capital structure. Think of it like a pyramid. At the very top, the safest part, are the secured bondholders. They lent money to the company with specific assets as collateral, like a factory or a fleet of trucks. Below them are the unsecured bondholders. And way at the bottom, with the least claim on anything, are the stockholders. In a traditional liquidation, the assets are sold off and the money is paid out starting from the top of the pyramid. By the time they get to the stockholders, there's usually nothing left. This is why buying the common stock of a bankrupt company is often a ticket to zero. However, companies often don't liquidate. They reorganize. They enter Chapter 11 bankruptcy protection to get some breathing room from their creditors and figure out a plan to become profitable again. This is where the opportunity lies, but usually not in the common stock. The real opportunity is often in the debt of the company, the bonds, or in a special class of securities that get created during the reorganization. Imagine a company that has a solid, profitable core business, but just has way too much debt. It can't make its interest payments. In bankruptcy, it can negotiate with its creditors to swap that debt for new stock in the reorganized company. So, the bondholders, who were once lenders, become the new owners of the company. If you can buy those bonds for pennies on the dollar when everyone else is panicking, you could end up owning a piece of a newly healthy, debt-free company for a ridiculously cheap price. This is not a gain for the faint of heart. It requires a lot of reading and legal analysis. You have to be able to value the company's assets and figure out what they would be worth in a reorganization. You need to understand who gets what in the bankruptcy waterfall. Greenblatt emphasizes that this is an area where a little bit of specialized knowledge goes a very long way. Because so few people are willing to do the work, the rewards for those who do can be enormous. It's like buying a structurally sound house that looks terrible because of peeling paint and a messy yard. Everyone else sees a wreck. You see the potential after a good cleanup. Let's talk about another special situation that pops up from time to time: rights offerings. This is when a company gives its existing shareholders the right to buy more shares of the company, usually at a discount to the current market price. Why would a company do this? Often, it's because they're in some kind of trouble and need to raise cash quickly. They can't just go to the market and issue new shares the normal way because nobody would buy them. So, they turn to their existing owners for help. This sounds bad, and it often is, but it can create a very interesting dynamic. The rights themselves can be traded. If a shareholder doesn't want to buy more stock in a troubled company, they can sell their rights to someone who does. The opportunity arises because these situations are often messy and misunderstood. Many investors don't understand what the rights are or how to exercise them, so they either let them expire worthless or sell them for next to nothing. Greenblatt's angle is to look for oversubscription privileges. This is a key feature in some rights offerings. It means that if some shareholders don't exercise their rights, the shareholders who do participate can buy up those leftover shares, still at the discounted price. So, you can potentially buy a lot more stock at a cheap price than your initial rights would have allowed. The trick is to find a situation where a company is doing a rights offering not because it's about to die, but for a more strategic reason. Maybe it needs cash to make a brilliant acquisition, or to pay down some high-interest debt. If you can identify a situation where the underlying company is actually decent and you can buy shares at a significant discount through a poorly understood rights offering, you're setting yourself up for a great return. You're taking advantage of confusion and complexity to get a bargain that isn't available to the general public. Another, slightly more complex area is recapitalizations. A recapitalization, or recap, is just a fancy word for a company significantly changing its mix of debt and equity. A company might, for example, take on a huge amount of debt and use that money to buy back a large portion of its own stock. This is often called a leveraged recapitalization. On the surface, this can look incredibly risky. The company's debt levels skyrocket. But think about what it does. By buying back its own stock, the company dramatically reduces the number of shares outstanding. This means that each remaining share is now entitled to a much larger piece of the company's future profits. The earnings per share, a key metric investors watch, can shoot up. Management is essentially making a huge, leveraged bet on the company's own future. They believe the company's cash flow is so strong and stable that it can easily handle the new, higher debt payments. These situations are often led by activist investors or private equity firms who see a lazy, undervalued company with not enough debt. Yes, you read that correctly, not enough debt. In their eyes, a company with no debt and a lot of cash is being inefficient. They believe that by adding leverage, they can force management to be more disciplined and unlock value for shareholders. For an individual investor, these situations can be a signal. It tells you that some very smart, very motivated people believe this company is cheap and has a lot of untapped potential. You can ride their coattails. The key is to analyze the company yourself and agree with their assessment. Can the business truly handle the new debt load? Is the underlying business stable and predictable? If the answer is yes, a recapitalization can be a powerful catalyst to unlock a stock's value in a short amount of time. So, when you tie all these things together, spin-offs, merger arbitrage, bankruptcies, rights offerings, recaps, what's the common thread? In every single case, the opportunity is created by some kind of structural quirk, a forced action, or a level of complexity that scares away the average investor and the big institutions. Greenblatt's genius is not in predicting the future of the economy or finding the next revolutionary technology. It's in understanding the structure and the psychology of the market itself. He's exploiting the fact that big money managers are often forced to sell for non-economic reasons. They have to sell the small spin-off because it's not in their index. They have to sell the stock of a company being acquired because their mandate is to own stocks, not to engage in arbitrage. They have to run for the hills at the first sign of bankruptcy. These constraints, these rules that the big players have to live by, create pockets of inefficiency. And these pockets are where an individual investor who has none of those constraints can thrive. You don't need a PhD in finance to do this. What you do need is curiosity, a willingness to read, and a bit of a contrarian streak. You have to be willing to look at a situation that seems messy or scary and ask, wait a minute, what's really going on here? Is everyone else missing something? Greenblatt provides a roadmap for where to find these situations. He's not giving you fish. He's teaching you where the best, most secluded fishing ponds are located. The work involves reading the documents. For a spin-off, you need to read the Form 10, which is the initial filing the new company makes. For a merger, you read the merger agreement. For a bankruptcy, you follow the court filings. This sounds intimidating, but Greenblatt's point is that just by doing this basic reading, you are already ahead of 99% of the market. You are developing an informational edge, not through illegal inside information, but through good old-fashioned work. Let's take a concrete, albeit simplified, example of a spin-off. Imagine a big, boring utility company called Megapower. Megapower also happens to own a small, innovative software division that creates billing software for other utility companies. It's a great little business, but it's buried inside Megapower. No one on Wall Street cares about it. Megapower decides to spin off the software division as a new company called SoftGrid. Megapower shareholders, who mostly own the stock for its stable dividend, suddenly get shares in this small, no-dividend tech company, SoftGrid. What do? Most of them sell immediately. The price of SoftGrid stock falls from a theoretical value of $20 to $10 in the first few weeks of trading. You, the genius investor, have been watching this. You read SoftGrid's Form 10. You see that they are already profitable, have no debt, and their management team, who came over from the parent company, were just granted a ton of stock options. Furthermore, you discover that the CEO of SoftGrid just spent $200,000 of his own money buying shares on the open market at $10. You see a profitable, well-managed company with huge insider buying, whose stock has been pummeled for reasons that have nothing to do with its business prospects. That is a classic Greenblatt setup. You buy the stock, and over the next 2 years, as the company starts reporting its own strong earnings and gets discovered by Wall Street, the stock goes from $10 to $40. This isn't a fantasy. This is the pattern that has played out time and time again in the areas Greenblatt identifies. It requires patience. The market might not recognize the value in your spin-off or your bankrupt bond for months, or even a year or two. This is another advantage you have as an individual. A fund manager has to report their performance every quarter. They can't afford to sit on an underperforming stock for too long, even if they know it's cheap. You, on the other hand, have no one to answer to but yourself. You can wait for your thesis to play out. In essence, Joel Greenblatt's message is one of empowerment for the individual investor. He argues that the game is not nearly as rigged as it seems. In fact, the very structure of the professional investing world, with its size constraints, its bureaucracy, and its obsession with short-term performance, creates a massive playing field of opportunity for the little guy. Your small size is not a disadvantage. It's your single greatest advantage. You can be nimble, you can be patient, and you can invest in obscure corners of the market that the giants can't even touch. So, the next time you hear about a company being spun off, or a merger being announced, or even a well-known company filing for bankruptcy, don't just dismiss it as noise. Your genius alarm should go off. It's a signal that there might be a special situation unfolding, a situation where fear, confusion, and institutional constraints are creating a potential bargain. It's an invitation to roll up your sleeves, do some reading, and see if you can find a hidden gem that everyone else has overlooked. That is how you can become a stock market genius.